Another tariff delay, this time with China, has sent risk assets soaring. These markets are being dominated by the headlines. Meanwhile, the economic data continues to roll in decisively on the downside. That's what's missing in all this. Trade wars didn't break the economy, so trade deals are not going to fix it. To begin with, tariffs aren't even going away, and we've seen this before. Back in 2018, markets were gripped by each and every twist and turn to the trade wars. By the end of that year, despite delays in deals, they happened anyway. More importantly, the weak economy, which had predated the geopolitical drama, won the war against central bankers and their inflation recovery narratives. Here in 2025, it's the same things. Tariffs are still there, and they're still at historically high rates, even if not as high as they were yesterday. But that's simply part of the process. Ratchet everything up initially to multi-generation highs, then they can only go down from there, making it seem like there is some good news. Moreover, no deals have been struck. The tariffs have only been delayed to give them space to talk. There were plenty of those talks in 2018, not that they did much good then. After it's all over, the tariffs are still there, but more importantly, so is the pre-existing weakness. That isn't going to be improved by trade deals one way or another. And that weakness is what keeps coming up all over the world. Japan is heading for another recession. It's second in 3 years, even before Trade Wars 2025. And the latest updates from there, they show an economy that's falling fast, including a big drop in bank lending. China's another obvious one. That country reported on Friday even more deflation in consumer prices, as well as, more importantly, the globally connected producer prices. Live by the headlines, die by the fundamentals. Risk markets are naturally focused on the trade deals because there's the assumption that trade wars and tariffs are the reason for all this economic financial upset to begin with. But the economy was heading in the wrong direction. We've got a number of examples. I talked about Canada just recently. We've got Japan as well as China. The U.S. and productivity, as I talked about with Steve, the U.S. labor market heading in the wrong direction. Trade wars did not lead the economy to this position. And so trade deals aren't going to fix it. Besides, even if there are a whole bunch of trade deals and all there is right now is tariff delays, it still means that the fact that tariffs might end up lower than the proposed right now isn't exactly the solution to the growing macro downside. But it doesn't matter. Stocks right now are absolutely soaring, rebounding from the market lows last month, which coincided with trade war and tariff delay announcements to begin with. Commodities are rebounding. We've got oil back about $60 a barrel. In fact, it's $62 per barrel. Even bond yields are jumping as we're getting into another one of these short-term pauses, in another one of these fluctuations in the bond market that we've seen repeatedly over the last several years. So risk markets, especially stocks that had plunged on the idea that tariffs were going to push the economy into a full-blown recession, are taking back the tariff part without realizing the full-blown recession risk hasn't materially changed. If anything, any tariff, doesn't matter what level, only raises the risk, which was considerably high to begin with. That's what the fundamentals are saying, and that's what the data is showing, especially in these key places like Canada, like Japan, and China itself. But what was reported over the weekend after meetings in Switzerland? The U.S. and China will temporarily lower tariffs on each other's products temporarily, and a dramatic ratcheting down of trade tensions that buys the two world's largest economies 3 months to work toward a broader agreement. Again, we've seen this before. The combined 145% U.S. levies on most Chinese imports will be reduced to 30%, including the rate tied to fentanyl by May 14th, while the 125% Chinese duties on U.S. goods will drop to 10%, at least according to a joint statement from officials in a briefing Monday in Geneva. In a research note, one of the Bloomberg economists said, today's move substantially lowers the U.S. average tariff shock on China, though here's the point, the remaining import taxes remain high and could still cut U.S. imports from China by about 70% in the medium term. All that both sides really said in their joint statement was, quote, the parties will establish a mechanism to continue discussions about economic and trade relations. And as I said in the introduction here, we've seen this before. We've seen it before earlier this year. We saw it back in 2018. If you don't remember the trade wars in 2018, in April and May, there was all sorts of rumors and announcements that trade deals were being struck, or at least trade deals were being negotiated, and that there would be delays in tariffs, including those imposed on China. Now, before we get back to the rest of today's video, I want to tell you about today's video sponsor. We talk all the time on this channel about the dangers the world is facing, trying to come to grips with the aftermath of the pandemic and the lockdowns, the difficulties associated with the supply shock and price illusion, not to mention still living in the shadow of the 2008 crisis. To put it mildly, there's a lot of systemic uncertainty. Now, I've recommended gold as a store of value hedge for years. In fact, it's the ultimate error hedge. But if all you're doing is owning gold, you're only preserving your wealth, not growing it. And that's where today's video sponsor, Monetary Metals, comes in. With Monetary Metals, you can earn up to 4% in their leasing program immediately upon funding your account. And there are higher yields available to accredited investors in their bond offerings. The interest that you earn on your physical metal is paid in ounces of physical gold or silver, which you get in addition to any price appreciation from gold and silver while you hold them. So join the thousands of investors earning interest in physical gold and silver every month with Monetary Metals. There's a link in the description of this video that has all the information that you need. We thank Monetary Metals for their sponsorship, and now back to the rest of this video. On May 18th of 2018, as the New York Times reported, American and Chinese officials made progress on Friday toward an agreement that could help avert a trade war, with China pledging to increase its purchase of American goods by at least $200 billion by 2020, which they never did, largely by lifting existing barriers that would make it easier for Chinese firms to sell and operate in China, which never happened, at least according to a senior administration official. To help narrow the trade deficit the United States runs with China, the Chinese would reduce tariffs and other non-tariff barriers that currently hinder the flow of American goods and services into China. Removing tariffs and other structural barriers would essentially allow another $200 billion worth of goods to enter China through 2020, the officials said. And when the announcement was made, markets were celebrating. They were risk on everywhere because this was going to avert the trade war. The discussions had reached a point where it looked like both sides were going to be able to come to an agreement, and therefore there wouldn't be any trade wars in 2018, no matter what. The very next day, Treasury Secretary Mnuchin went on Fox News Sunday and said, "We're putting the trade war on hold. So right now we have agreed to put tariffs on hold while we try to execute the framework." Exactly what we're hearing right here in May of 2025. Except in May of 2018, just 10 days after that celebratory announcement saying that maybe they had found a way to avert tariffs and trade restrictions, just 10 days later, they imposed them anyway. And it was downhill from there all the way into 2019. In fact, all of the narratives that had been building in 2018 were shattered in 2019. Not by trade wars, though trade wars didn't help. All the academic research says that there was a modest decline, a modest drag on the global economy due to tariffs and trade restrictions, but it was the weak underlying fundamentals that ultimately did everything in. While everybody was focused on the back and forth with these negotiations, meanwhile, the real weakness in the global economy continued unabated. You see that everywhere. Chinese GDP from fourth quarter of 2018, when the weakness really hit the landmine, as we call it here at Eurodollar University. Ever since the fourth quarter of 2018, or really the third quarter of 2018, starting in the fourth quarter of 2018, GDP in China slowed, and it has never come back. It has never recovered. And you see that in all the statistics that go along with it. Retail sales in China. Before 2019, China had never seen less than 8% on retail sales growth. Now they're lucky if they can get 4 or 5%. So China never came back from the 2018 recession, the 2018-2019 recession. Even in the United States, the ever-inflationary Fed went from screaming about a labor shortage and the inflationary fears over wages, and even speeding up its rate hikes in 2018 because of all of that, to ditching inflation, rethinking employment dynamics, and outright cutting rates in 2019. They even restarted QE without calling it QE because of the repo market that broke down in September of 2019. Europe went from raising rates, or at least considering raising rates in 2019 for the same reasons as the Fed, what was supposed to be Mario Draghi's last win, to later in 2019, by that September, officially resuming QE across Europe. It wasn't trade wars and trade restrictions. That was the headlines everybody focused on, all those twists and turns. It was the underlying macro weakness that, before we ever got to COVID and the coronavirus, created a recession in the global economy in 2019. Japan was a perfect example of all this. The Bank of Japan had been relatively sanguine earlier in the year 2018, with Haruhiko Kuroda, who was the Bank of Japan's governor at the time. He was even talking about ending QE for the first time in basically forever in Japan, maybe even getting to raise rates too. But that all fell apart in October 2018 too, the global landmine. That was a warning, similar to what we saw in April of 2025. But then Japan slipped into outright recession right then at the landmine late in 2018. Even though the Japanese government wouldn't officially admit to it until July of 2022. No, you didn't hear me wrong. It took them nearly 4 years to admit that the economy slipped into recession way back in late 2018. This was long before the coronavirus. It was during 2019. It wasn't about trade wars. Trade wars may have contributed something, but it was mostly about economic weakness that nobody appreciated because they were focused on the headlines to all this tariff stuff. Now we're starting to see something similar develop here in 2025. Economists and analysts over in Japan are now forecasting a recession in GDP even before getting to the tariffs I talked about in a recent video. They're starting to realize Japan wasn't as strong in recovering in inflationary as the Bank of Japan has been trying to make Japan out to be over the last year. According to a media report, a decline to GDP would cast a shadow over both the Bank of Japan's plans to steadily continue with policy normalization and Prime Minister Shigeru Ishiba's election hopes this summer. It also highlights the weaknesses in Japan's economy even before it was hit by stringent tariffs from its biggest security partner and raises the chance of a technical recession. And it's only a technical recession because first quarter GDP is likely to be negative, second quarter GDP likely to be negative. That's not a technical recession, that's an actual recession, especially considering that Japan's last recession was only 3 quarters before we got to this latest recession, which means the recession actually didn't end in 2024 as everyone had assumed. It's one continuous recession. We call it forgot how to grow, but that's really exactly what it is. And economists are coming around to realizing the economy they thought was really good in 2024 actually wasn't. It wasn't trade wars and tariffs and trade drama. It was the weakness that was developing the forgot how to grow economy for the last couple of years at risk of transitioning to something worse, remembering to do something worse. Continue with the article. There's no engine to drive Japan's economy at the moment, said Yoshiki Shinki, who's a senior executive economist at Daiichi Life Research Institute. This is even before the Trump tariffs hit. I see a good chance of another quarter of contraction following right after the first one. So first quarter, then the second quarter. And a trade deal with Japan and the United States might take years to hammer out. In fact, Ishiba, Japan's prime minister, this weekend said, Japan won't accept any initial trade agreement with the U.S. that excludes an accord on autos. Ishiba on Monday made his stance clear when asked in Parliament about the possibility that Washington might urge Tokyo to strike a provisional agreement that doesn't address U.S. tariffs on car imports. So Japan's already in rough shape to begin with, falling into recession without the tariffs. The tariffs, while there's a delay on trade restrictions to give the situation time for parties to talk, even Ishiba says this is not going to be, there's no easy way forward. And if there's no easy way forward with Japan, how's there going to be an easy way forward or a straightforward way forward from China, with China? And the economic data we keep getting, in this case from Japan, continues to be worse and worse and worse. The widely followed EcoWatchers survey from the Japanese Cabinet Office, that one had been 49 back in December, the artificial high that hit Japan too, and by February it's already down to 45.6, but the latest numbers here for April of 2025, 42.6. That's the lowest since February 2022, just coming out of the lockdowns. And also the Cabinet Office has changed its overall picture of the Japanese economy, estimated by the EcoWatchers survey, by saying now that it sees signs of weakness before having said Japan was in a modest recovery. And some of the details behind the EcoWatchers survey are even more concerning. The household indicators, those fell to 41.6 in April, having been as high as 49.2 in December. Again, the sharp loss of economic momentum that we've seen all over the world, without tariffs having been really implemented at all. The Employment Activity Index from the EcoWatchers survey, 44.1 in April. That had been 49.9 in February, so you're talking about a almost 6-point drop in just 2 months, and that 44.1, the lowest since January of 2021, so basically the entire cycle so far. So even in Japan, where employment is almost a given and nobody really questions it, you're getting a lot of noises and indications that Japanese businesses don't like where things are heading in Japan. Don't like where things are heading because of where things actually are before getting to all of that. And there's more. The bank lending statistics from the Japanese banking sector. Bank loans increased by 2.4% year over year in the month of April, which was well below the 2.8% that had been expected. And that's the lowest growth rate since September 2022, back when Japan was coming out of its COVID emergency measures. And that rate had been 3.1% in February, so you see a sharp deterioration, a sharp deceleration in bank lending growth in just the last couple months. And for big banks in April, the year-over-year growth rate was just 1.8%. So big banks are really pulling back. And by the way, this is something I just wrote about at Eurodollar University's deep dive analysis. So if you're interested, check that out there. We went deep into not just what the banking sector is doing in Japan, but why the banking sector in Japan is a reflection of all these global conditions through their overseas branches. So while the Japanese economy is in big trouble to begin with, so is China. China's economy. We've been talking about this for years, and it hasn't gotten any better despite Beijing's best efforts to try to stimulate everything. The PBOC last week announced that before these talks with the United States on trade deals, they announced they were cutting interest rates on basically everything, which is not exactly a sign of projected strength and confidence. If anything, it was another admission that China is in rough shape. And that's what the economic statistics continue to show. The latest were consumer prices and producer prices from the Chinese economy. The CPI fell by 0.1% year over year in the month of April, which was the third straight deflationary signal from Chinese consumer prices. And while it did tick up by 0.1% on the month in April, that followed two bigger declines in March and February. Even the core CPI rate in China, just 0.5% year over year in both March as well as April. There's no consumer price increases there because demand continues to be subdued, putting it kindly. And this is before we get to the heart of trade restrictions. And in many ways, some of these numbers are supported, artificially boosted by all the activity that was front-loaded into the early part of this year and the late part of last year to try to beat all these tariff restrictions to begin with. So we haven't even talked about the payback in China, which is ongoing as we speak. We see that start to creep in producer prices. China's PPI fell by 2.7% year over year in April, which is the biggest yearly decline since last October, accelerating to the downside because the payback is starting to emerge. On a monthly basis, the PPI was down 0.4% for the second month in a row. Not a good sign there, especially since Chinese producer prices correspond and correlate strongly with global economic data, up to and including U.S. wholesale sales, because so much of what China does ends up in American markets, which is basically the matter that's at the heart of all these trade problems to begin with. In China's PPI, talk about deflationary circumstances, they're down 9% total since the middle of 2022, when the forgot how to grow world showed up. So what the Chinese are saying is the world forgot how to grow in 2022, and ever since then, it has been forgetting more. Forget how to remember. It has been forgetting more how to grow, and the downside continues to emerge more and more as time goes on, before we get to all of these trade restrictions. As even the South China Morning Post said, although the trade war may ease to a degree as China considers entering negotiations with the United States, tariffs remain prohibitively high and continue to stifle bilateral trade, leaving Chinese manufacturers with mounting stockpiles of unsold goods, which will be deflationary, not inflationary, especially as the Chinese struggle to find places to sell all this stuff that's been accumulated on top of all these other places around the world that have been accumulating stuff before tariffs that then have to try to sell them too. There's weakness in every direction you look at, regardless of what the ultimate tariff rate ends up being. So like Japan, China is a mess. China is still a mess. China has been a mess for years, and that's not changing with the global implications of trade negotiations and potential trade deals, assuming any of them actually do get struck this time. But markets that were depressed on the prospects of trade wars interrupting what they thought was a strong and resilient economy are predictably soaring ahead with the prospects of trade deals unwinding some of those negative sentimental pressures. But Trade wars were not the reason for the economic weakness that we're seeing, and all the data we keep getting shows and reinforces that notion, especially from places like Canada, as I keep mentioning, as well as Japan and China itself. The evidence keeps pouring in for pre-existing weakness. So as we move forward here in May of 2025, nothing has really changed. The only thing that may have changed is the potential high rate for tariffs. That may be coming down from what everybody feared at most last month, but that's it. Nothing else has changed. The economic fundamentals are exactly the same. And what we're seeing from all of these different places around the world is dramatic economic weakness, loss of economic momentum, to the point that even economists are saying, yeah, we see it too. The global economy was in bad shape ever before we got to all of these trade wars and trade barriers. So trade wars didn't break the economy. Trade deals are not going to fix it. As I mentioned, Canada, another really good example that weakness didn't start with trade wars 2025. The latest data from Canada, payroll report. All the details in the video linked below. As always, thank you very much for joining me. Huge thank you, Eurodollar University members and subscribers. And until next time, take care.